Leverage ratios are often considered when analyzing fundamental data for a company. They usually consider the liquidity or bill-paying ability of the company. Low liquidity can be a signal of bankruptcy. Leverage ratios vary immensely across industries, so comparisons should be done to peers within the industry. The use of debt and equity are financing decisions that every company must make. Market and economic conditions affect the decisions as each funding source is associated with risks and costs. Financial leverage ratio compares total assets to total equity from the latest balance sheet. Lower is typically better as it implies there is less of a debt burden on the company. For example, a company with $10 million in total assets and $50 million in total equity would have a total asset to total equity ratio of 20%. A company with the same level of total assets but only $25 million in total equity would have a higher ratio of 40%. The first company has less debt in their capital structure and possibly less risk to equity investors. The financial leverage ratio is a variation of the debt-to-equity ratio and should follow a similar trend. Advantages of leverage ratios are that they are easy to compute and to understand. The ratios give valuable information about a company's operations. Disadvantages include that ratios are not comparable across industries, which can make evaluating the companies very difficult. The general trend in a ratio over time is informative. Falling leverage ratios may imply that a company's liquidity is declining or may hold other information about a company's cash management and debt levels. Viewing the components of each ratio separately can be helpful as well. If the financial leverage ratio is decreasing, is it caused by a decrease in assets or an increase in equity? Or could it be a combination of both? In this example, Papa John's financial leverage ratio is currently at 5.4, which is its 10-year high. Since the ratio is assets to equity, the ratio implies that assets are 5.4 times as large as equity balances, so they are largely funded by liabilities. A lower leverage ratio is preferred. Less debt might mean a stronger balance sheet, less risk to equity investors, less leverage, and more liquidity. More debt might mean more profitability. It would be wise to view the financial statements and filings to learn more.